Rising interest rates are going to pose a fiscal challenge to governments across the world. The public finances of developed economies have been flattered by the ultra-loose monetary policy in place since the financial crisis. Low interest rates have kept a lid on the interest payments governments face, freeing up funds to be spent on other things, as shown in this part of the chart. According to Fitch, if Eurozone interest rates had remained unchanged from 2007 to 2017, collective interest payments by the bloc's governments would have been nearly €1 trillion higher. That has saved members of the bloc an average of 0.8% of their GDPs over the period. But the credit rating agency also finds that nations have spent the savings. Public debt levels as a percentage of GDP have risen during the period. That's shown on this part of the chart, and with a direction of travel along this end of the chart's axis. Now that rates are starting to rise, taking funding costs with them, governments are looking at some difficult spending decisions. Increased inflation and reduced central bank bond buying programs are not the only threats to the holders of US government debt. There is another worry that the capital markets face: a rising tide of supply. The total amount of debt the US Treasury will have to issue in 2018 will reach $1 trillion in the year, according to research from Deutsche Bank. That's because of the need to make up for the drop in income caused by President Trump's tax cuts. It is up by over 50% from a year earlier, raising questions about who the eventual buyers of US government debt will be. The question takes on deeper significance during a sharp rise in the amount of corporate debt that is due to mature.